Hello and welcome to Any Answers Answered for September 2023. Hopefully you've had a restful summer, ready for all the excitement that is to come over the next few months, no doubt. Our first question this month comes from Ozzy. And Ozzy's question, Tim, is to do with the declaration of trust. A couple owns a residential property but want to transfer the right to income but retain the capital ownership. Ozzy explains, I have a husband and wife client who currently reside in a residential property that they are looking to let. They have lived there since purchasing a number of years ago and are now looking to move out but want to retain ownership and rent the property. There's only a declaration of trust here, and can it transfer, is the question, the right to income from one party to another, but both have to have current ownership of the property? Is that right, that they both have to have ownership of the property, Tim?
No, and I don't know where Ozzy this idea has come from, but there is no requirement for the beneficiary of a declaration of trust to have any previous interest or current interest in the property. Interestingly, there are only two postings to this particular question on the Any Answers thread. One by the Dullard, who, as I've said, says no, your clients can give away the right to income to a person that otherwise has no interest, and the other by the frequent poster Tax Dragon, who says, yes, your clients can give away the right to income to a person that otherwise has no interest, using a deed of trust if they want to. But the real question is it going to be tax efficient? Because the settlements legislation, very widespread and long-standing anti-avoidance legislation, which, as Tax Dragon indicates, we'd have thought almost every tax agent, qualified accountant would have heard of, and which is quite often the subject of tribunal cases, that settlements legislation can make the idea of transferring income for tax purposes to another party ineffective. Now, we're looking in this case at husband and wife who own the property themselves. Presumably it's joint ownership, 50-50, doesn't say whether it's tenancy in common or joint tenancy, but they want one of the couple to enjoy more income, or all of the income possibly, as opposed to the other couple. And that's because one of them has a lower marginal tax rate. So if we can have a declaration of trust to the effect that the entitlement to income is different from the entitlement to the capital value of the property, would that effectively give rise to lower overall tax than if we left it as it was, as a 50-50 split? And of course, this sort of husband and wife planning is pretty important. Now, where a couple own a property jointly, as they do here, then the presumption for tax purposes is that it will be a 50-50 split of income, irrespective of the beneficial interest in the property itself. So it could be that they're tenants in common, with one of them having a 90% interest, the other having a 10% interest. But ordinarily, that'll default to a 50-50 split of income, unless they complete the Form 17. And on the Form 17, they would express the actual beneficial interest as being 90-10, and the income would then follow that. And so if the husband and wife, Ozzy's clients here, want to achieve anything other than a 50-50 split, first, they need actually to transfer the beneficial interest in the property itself, let's say from 50-50 to 90-10. So they would need a deed of transfer of the beneficial interest in the property from one of them with 50 to the other, so that the other ends up with 90. They've now got a 90-10, and they can then submit a Form 17, and that would then result in a 90-10 split. So it's not quite as simple, which may be why there aren't as many posted answers as it looks at first sight.
Okay, our second question comes from the wonderfully named Minimal Damage. And the question here is a slightly confusing question. I think, as I read it, director charging rent, the company is the fundamental thing we're going to talk about here, Tim. We've got a director who is living in a flat Monday to Friday and apparently is working, I think, from that space as well. As Minimal Damage says, pretty standard scenario, director owns the flat that he uses to run his company from and charges the company rent. The company gets corporation tax relief. He reports the income on his tax return, which ideally is offset in full by a portion of expenses. However, the monthly rent charged to the company seems to be much higher, by around 300% more than when it was let on the open market, and the director only resides there Monday to Friday. The question that follows is there a potential benefit in kind? Other employees would not be charged on the accommodation paid by the company when working away, but does this apply to a director who actually owns the property? Let's start with that, Tim, in terms of whether there is a benefit in kind for this particular individual.
No, there isn't. It's easy to get in a muddle over these things, but if we drill down to the basic fundamentals of this scenario, the director owns the property. His company is paying him a monthly amount, which is being described as rent, and the company is claiming corporation tax relief, and he's describing it on his tax return as rental income and claiming deduction of expenses. What we have to ask is this really a rental agreement? It's got nothing to do with the benefit in kind legislation. The company is not providing him with any accommodation. He owns the flat. You can't be provided with something you own yourself already. And the real question here is whether it is simply dressing up payments by the company to its director shareholder. I'm assuming he's the controlling director. It's dressing up payments that the company is making to him as though they're something other than a payment to a director, which would be a distribution or remuneration or a loan. It's dressing up as rent. Well, where's the rental agreement? What is the rental agreement? On what basis is he allowing his company to use the property that he owns? So it's not a benefit in kind issue at all. The issue is what exactly is going on here.
I think it's very easy to get into a muddle in these situations because so much is happening with what we think is all one person, but we have to look at them in different ways. The landlord, the employee, the director, the shareholder, the homeowner. The point, quite simply, is that if this person wasn't working somewhere else Monday to Friday, we were simply in a position where the company was paying some money to the individual for, let's say, the family home, in fact, and they were there all the time. It's not an accommodation issue. It's not that they're providing accommodation that would be taxable as a benefit in kind. It is, in fact, that they're providing space for the person to work from. And then we're really into kind of use as home as office, or the corporate equivalent of use as home as office. And that's where we would want some evidence that the paperwork was all right and supported that situation.
Yes, and Minimal Damage, the original poster, says in the comments, the arrangement might be temporary. I don't want to give too much personal detail, but my understanding is that he had to leave the home he used to live in, so this saves him having to stay in hotels. As far as I know, no formal agreement is in place either. Well, that's the end of it, to my mind. There's been, I imagine, a marital breakdown. He's left the matrimonial home. He owns separately a flat that had been perhaps rented to somebody else, but he's now living in it. Well, it saves him having to stay in a hotel, but if the company were paying his hotel accommodation, that would be a benefit in kind. But the company is not paying his hotel accommodation and providing him with money just because he's living in a flat that he owns has got nothing to do with the benefit in kind. And the way in which the original poster then says, as far as I know, no formal agreement is in place either, really clarifies that this is not a payment of rent. For it to be a payment of rent, there would have to be some formal licensing or lease agreement, and clearly there isn't. And so if I was an HMRC officer looking at this, I would disallow the corporation tax deduction in the company and argue that it was a distribution to the taxpayer by reason of his shares, or alternatively argued it was remuneration that should have gone through PAYE and NI and leave the corporation tax deduction in place.
I often find it's the simplest things in tax that actually cause us the most difficulty to make sure we've got our heads around it. This idea of corporate rent to a direct working from home, so frequently something that we need to look at in more detail. In this month's Tax TV, in fact, Tim and I do carry on that conversation to have a look at the ins and outs of working from home, self-employed, corporate, everything. Hopefully useful, both questions to the two people who asked them and various other people as well. We look forward to seeing you in a month's time for some more questions. But that's all for this month's Any Answers Answered. We'll see you later. Bye-bye.